Hello everyone, this is Juan Sarmiento and today is Friday, September the 22nd. So last week we discussed how to create my standard graphics, my charts that I like the most. If you set a yellow link here, every time in your watch list you select the same link, all you have to do is click on any of these candidates, any of these stocks, and it would appear here just by clicking on it. See that? How it gets adjusted immediately, and then we move on. Okay, that's very useful. If you want to create a new watch list that is with your own names that you selected, you can also create lists that are that come from some selection, some scan. But look at all the different lists that I have. I have here one for futures. You can see some of these futures and they will be displayed here. Okay, so let's create a new one. Okay, so click here and you go down and say create watch list. Name it what you will. Let's call it candidates. And let's say for this week I may have something like Apple, Google, Amazon. By the way, these are typical stocks that I might be trading because they're high flyers, and these are stocks that tend to go wild sometimes. And then we have something like Adobe, which is also one of the darlings of the Wall Street. Adobe and FedEx. It's better if you have a diversified portfolio, but it's not necessarily the case. Okay, so here we have Apple, and very quickly you can tell what is Apple doing. Well, it's below the Ichimoku cloud. It's at the bottom of the chart here on the oscillators, and the IBSV is yellow, so that's not a good candidate. I want green lines here at the very end at least. And you want this chart to be here, sort of at the bottom of the yearly chart. Okay, so this is 52-week chart. It should be right there. Let's see if we find one like that. Google, no, it is right now spiking. So what happens right now is sort of high volatility, and that coincides with the stock declining. So that's not what we want. We want low volatility. Amazon, same thing. It's a little spiky right now, and the stock has pulled back. Adobe, pulled back a little as well, and look at this. It's been much lower before. This would have been a better moment to pick it up. And then finally, FedEx, that's looking a little better. And why do you think the volatility's dropped so much all of a sudden? Well, it's related to earnings. So we are going to find our candidates for our trades in this particular situation. Right after earnings, volatility tends to decline. Look at this big decline here after every earnings, but we want it to be very close to the end here. So you want to know how low the volatility is in relation to the yearly chart. Go to the trade tab, all products, select your stock, FedEx, and then go down here where it says today's option statistics. And then you see that current IV percentile is 6%. So it's very, very near the bottom. Do the same for others. Apple, not so. Apple is at the 21 percentile. So I tend to pick those that are 15 or less. Okay. Now you may say, why are you picking this for? These are candidates for the Genie trade. And this is the name I baptized it because my dog, he was called Genie. Okay, simply put. No, it's a nice name. It's like Genie in a bottle. It's a magic sort of trade. At least I would like to think so. And what is it the Genie trade. The Genie trade is traditionally called the put-call ratio combination, the put-call calendar ratio combination. And it's essentially a combination of two straddles. One is in the front month and it's a single straddle, and then another one is in the back month, and there are two straddles for that month. So the balance is 2 to 1, all right? So let's say I want to trade this FedEx. Okay, I want you to go to the trade tab and look at your chain here. Okay, I want you to sell something around the 30 day to expiration. That's what this number is there, 30 days to expiration. So I'm gonna sell a stock, a straddle that is at the money. What is at the money? Well, if the stock is trading at 263, the closest number we have is 260. So I'm gonna click here and I'm gonna say analyze or buy, or in this case sell, sorry. Oops. Sorry about that, my mouse got frozen, so I have to pick another one. Okay, so we are gonna sell a straddle, just one single one, okay? And then analyze that, analyze trade. And here's what it looks like on the risk profile. That's a simple straddle, front month, meaning 30 days to expiration, in this case 28, and it's as close out as I can make it as to the current stock price. And then on top of that, I'm going to buy somewhere in the back month. There are many back months, obviously, but the one that I'm going to pick up is 90 days or more. In this case, 119 is the closest to 90 days. Without being under, and then I press the control key and look for the 260, same strike price, and I say analyze by straddle. Bing. Okay, that didn't work. I needed to press the control key and keep it pressed. Straddle. Okay, and do it again. Straddle. There you go. And this is the Genie trade. Okay. All right. So let's say I want to trade this. Look at the risk profile so you know what it looks like. Make sure you unlock this, because otherwise you're going to get the wrong price for it. This is your Genie trade. All right. Now, why would I trade this? Well, usually what I want is low volatility, but with a low volatility comes usually a jump. And here's a jump. Let's get closer so you can see that. Yeah, it jumped pretty much. It was here 250 and it went up to 261. Well, that's not, I want to see something like 10% jump. So this is not quite, but nevertheless is approaching the 52-week high. So I like that. I like stock that is about to keep on going. Then look at the earnings. You just put your cursor over the earnings day and you see earnings 4.55 is the actual versus 3.7. Okay, that's a beat. It beat by a wide margin. That's good. That means to me that the stock has the potential to break out to new highs, move a lot fast and all that. But if I'm wrong and the market collapses, then volatility will begin to rise. And that's why I picked the low volatility, because if I'm wrong and the volatility, the stock goes down, volatility will go up with that, and then I make money anyway. All right? All right, so that's the Genie trade. Now, what we're going to do next is simply create an order. And look at this here. If you click on that, you are going to save a custom template, and let's call it Genie trade. So that every time you select that Genie trade, it will create that trade on any stock. Okay, so let's go to Adobe. You see this is red. How about we change it to yellow? So that when I click here, it goes to Adobe. Good. Let's add simulated trades, and let's say you choose that January trade one and look for the option that you like. I guess 515, and then I said by custom. Oh, it's not going to appear here. We need to go to the trade tab. By custom, and it should show here as Genie trade. Okay, obviously I've done this before because I have, there it is. It created the Genie trade for Adobe. Let's analyze that and then make sure that it is the right option to sell. Well, you can sell the October 20 or the October 27. 27 is fine. And then the January is the option I'm buying, and the strike price is the current price. And then we are going to examine if this is a trade I want to make. But for now you know what a Genie trade is. You can save it and call it again, and that's the first step. We have created a template we can call again, and we don't have to repeat. But remember simply that is, and you can create another trade by selling the front month options, call and put, so that it makes a straddle, and the back month you buy twice as many straddles as you sold. Okay, so it's 2-to-1 ratio. All right, let's go to a spreadsheet. This spreadsheet I use to evaluate whether that's a good trade or not. There are certain things that I want to look at. Okay, now look at my, first of all, my account is 100,000. I can put 10 trades of $10,000 each, but I'm not gonna be risking the entire $10,000, because in 10 bad trades I could lose everything. No, in all likelihood you lose perhaps $1,000. And what I suggest is that by the time the first expiration comes, the first expiration meaning the expiration of the front month options, you decide that you lost, let's say, too much. If you lose, even if you lose $500, it's better to close that trade. That's a decision point. Do I continue on or not? You can take profits, you can close the trade, you can cash in and say goodbye, or you can say, no, I want to roll it over, which would mean we would sell that, we would buy back that straddle, presumably its value would have been declining, and I'm gonna sell the next month straddle. And that's called a rollover, and you're gonna hear that word more. But for now, let's see if I want to trade Adobe. I just created a trade in Adobe and a trade on FedEx. So let's copy Adobe here. This trade, I say copy the trade and take it to my spreadsheet. Okay, put it here, paste, create the same thing, okay, to the best of your ability. And yep, and I have the price here, 111.88. Okay, I can put that price here. Double click here, and that's the price, 111.88. And I multiply times 100 times 1. Put a comma there instead of a dot. There you go. This is too much money. Okay, 11,000. No, I wanted to spend only $10,000, not $11,000. So this is too much money for my account. So you can look for another trade. And in the future, in the near future, I'm gonna show you how to select possible candidates, how to locate them, because I already examined those few stocks, and none of them was a good candidate. Okay, let's look at the other things I had here. Earnings expectations, that's another feature. If the earnings expectations, the beat, is more than 10%, that's a candidate. You see how I say here, trade? Well, that's already a no-go because it's got me 11. But I want to show you just the same whether this is worth trading or not. So let's go to the chart And here you put your cursor and you see this says 3.169. Okay, that's it. 317 versus 0.09, 4.09. So I'm going to put 317 here. 3.17 by 4.09. And the balance is 90 cents, which is 29%. Wow, that certainly is more than 10%. Look what I put here. The company beat expectations by a wide margin, and I mean more than 10%, which suggests that the stock price will continue to rally in the weeks ahead, or revenue or earnings guidance might have been raised, or an important revenue source was revealed, and that would explain why the stock went up. If it went up, if it didn't go up, obviously this is declining, so that's not even a good candidate. I just picked those out of a hat, so to speak. Okay, my favorite stocks or whatever. So this is not a good moment to trade Adobe. And that's a strike against it. Okay, it said here, no, that's a reason for it. Rather, it is a good thing. That is 29%. But what is strike against it is the price and the fact that the stock has been declining instead of going up. I want the stock to go up 10% over the last 15 days or something like that. And I have that as in my scanner to pick stocks. Okay, let's look at the volatility skew. What is this? Well, let's go to the trade that we have selected right here. You see down in the bottom right corner of your screen, it says volatility. And then you have 35, 27, 31, 27. Okay, you can see that is front month and back month. I want that information in my spreadsheet here. So back month. Okay, so we have, note that I'm putting the numbers from this chart here. So 35.63. Then the other one, 28.08. Okay, the average of those calls and puts in terms of volatility is 31.8. And now I'm going to put the front month, 31.32. And 27.44. Now what we want is the front month volatility to be the expensive option, because that's the one I'm selling. But that's not always going to work out. So I accept that I'm going to have a difference in volatility, and if it is less than 3%, I'm happy, and that means I could trade this. So we have two items here that I wanted to match. They both worked. Now let's look at liquidity. Liquidity is simply how easy it is to get in and get out of the trade. Okay, a stock like Adobe is very commonly used. It's probably has lots and lots of options. It's not going to be hard to get in and get out. So how do you come up with this liquidity? Well, create the trade, create duplicate order, and then you see mid and natural. We're going to use those two numbers, mid and natural, and that will tell me how easy it is to get in or get out. Natural, the mid is 111.83, and the natural is 113.4, and the difference between those two is 1.4%. Okay, if this number is 3%, I'm happy. Okay, just so you know, you take the first number, the high number, subtract the low number, and divide by the high number. That's how I come up with that formula. Same here, something very similar here. Okay, the average of the front month options minus the average of the back month option. Front month, I'm saying front back month minus front month. That gives us that percentage. Here is percentage of the difference is 1.4. Then the current IV percentile, well, I showed you that already, but in case you didn't catch that, go to the trade tab and slowly scroll down, and you see current IV percentile. It says 57. 57. Look at the chart here. Yeah, it's sort of very high here. So that's not going to work at all because I want this to be 15. So 57 here is too high and it's going to tell me not to trade it. Okay, and this will be red. Okay, now you have of the 4 conditions, 1 didn't work, but price is another condition. So of the 5 conditions, 2 didn't work, and price is sort of determinant because I don't want to take excessive risk. So this is not going to work. So let's do the other one. Let's see if if the FedEx will work. Go to FedEx. I'm sorry, just click here. Yeah, this one jumped very nicely. I like that with earnings. Okay, so let's do the same analysis. You can come over here, the trade that we created, copy that, copy trade, and take it to the spreadsheet. Let's duplicate this, okay? Duplicate, and here we're gonna put FedEx. And then we can come back to the spreadsheet next week and see if we have changed our minds. Something may have changed. FedEx, paste it here, and the price 49.15. Okay, so come over here and put a price here, 49.15. So that means we can probably do 2 trades. Okay, so let's put times 2. You can always change that. Yeah, that's less than 10,000. Fabulous. Okay, we can trade this. You can change this data for the straddles. I'm not going to do that because it takes time. And just to remind yourself, what is it that the trade we used? But it is right here. It says January 24th, January 19th, 2024, and October 23rd, 2023. Okay, you can put all that data here. The strike price would be 260. Oops. 260, you can put it there. Okay. And how many straddles were you selling 2 and buying 4? That will be immediately apparent once we do this work. Okay, let's go to the expected and all that. So go to the chart, and here, what was the earnings? 3.69 was the expected and 4.55 was the actual. 69 for 3.69 versus 4.55. Yeah, that was a big beat, 23%. Okay, that's a potential candidate. Then we do the same with the options. I'm gonna do it quickly here, not waste any time. Oh yeah, okay. So we do the average for the back month, 30.29, 22.09. If you wonder, those numbers are here in the chart in the right corner of your screen, right bottom corner of your screen. And for the calls for the front month, 24.97, 20.04. The difference is more than 3%, so it says do not trade. Okay, unfortunately that didn't work either. And the liquidity should be liquid enough. Create duplicate order, and we have the mid and the natural. Okay, put those numbers here, mid 49.08 and 49.70. Okay, the difference is 1.2, perfectly acceptable. Now the current IV percentile, again, go to the trade tab, scroll down, and current IV percentile is 4%. Perfect. That would be good, but you have to see the price is fine, the earnings, well, that's quite motivating for me. This is not. This is pretty much a disaster waiting to happen because the options here are too cheap at 22%, the average of the two, versus the expensive options, which are different. And what is going to happen is this could rise and this could decline. In either way, we lose. So you start something very similar, and that makes it easier. Liquidity is fine. Okay, so let's go to the Analyze tab. What else can we do? Remember that I told you that you could sell the October 20, but you could sell also the October 27? Well, reproduce that. Analyze, duplicate. analyze trade, and then change this to October 27. Unlock, and then look at those numbers again. Yeah, that's not much different, is it? Yeah, it's just a tad higher here. Okay, so let's see if that made a difference. I doubt it, but let's go over here, and we entered 25.74. And 20.11. Yeah, not gonna work. It's getting closer, but I'd rather wait until next week. Okay, so this game is wait for the right time, and the other game is the cover calls. But today we're gonna stop right there. There's a lot to absorb. Make sure you watch the video again. Create your own spreadsheet. Ask if you don't understand something in the comments below. I'll be happy to follow up. Okay, that's all for today. Thank you very much for joining me. See you next time. Bye bye.